We think after a pretty significant reopening boost in first quarter, it's pretty clear that they're fighting some deflationary pressures. And it's quite possible that if the July CPI number that's going to come out pretty soon, we might see an outright deflation number. So basically slightly negative inflation compared to a year ago. And that's really what matters for the economy, we think. We're talking about an economy where demographic profile is becoming more challenging. And as we highlighted just before, the geopolitical environment will even get worse next year because the U.S. is now entering a presidential election season. So it's really important for them to put forward a credible reflation plan in which they use inflation as a bit of cushion. Right now, markets still debating on how effective the current package that put forward by the leadership could be. And it makes sense that the markets are struggling to find the direction at the moment. But we do think they're going to come up with a slightly more concrete measures in the coming months.
You think they're going to go deflationary almost immediately?
In July numbers, for sure, the CPI inflation will be negative in our view because ex-factory prices, if you look at them, are deeply negative. So that's going to affect the goods numbers. So the July CPI inflation will be slightly negative. Now, we still expect the inflation numbers to rebound a little bit toward the end of the year, but the risk around the scenario has risen, given the weak inflation numbers so far, with the deleveraging dynamic for the consumers and private businesses. So it's very important for the leadership pushes back pretty hard and achieve at least a level of positive inflation going forward.
Okay, what if right now, because we're seeing that deflationary fear, and you mentioned input prices, and we know they're in the hole. But what if we do get any kind of substantive stimulus, and even if it's just what people don't necessarily want all that much, in terms of more infrastructure, more substantive money going into the system, the impact that would then have on commodity prices would be significant because right now commodity prices are betting on a recession. So we've got crude prices that are on an upward run, and all these measures that are being put into place by OPEC to constrict supply. We've got then, if that was to be the case, base metals and the like will absolutely start ripping. Is that not inflationary enough in terms of what that could then mean for China manage to eke out of deflation a little bit, because obviously all the prices would have to go up, and then I suppose the requisite impact that could have more globally, because it's good news for China, but it's probably bad news for everyone else that has this expectation the Fed's going to stop.
Well, for China, I think what really matters is the domestic conditions. We could potentially have a feedback loop between the external commodity prices and the internal domestic inflation at some point in the future, but that's not the primary concern at this point, especially with the CPI inflation almost at zero right now and potentially set to fall to negative territory. But as you said, proper stimulus push would indeed generate a significant upside for commodity prices. Commodity prices have stabilized a little bit, but we haven't seen a massive rally yet. So that's an indication that the markets are still skeptical about how effective the new stimulus measures could be. Now, we still think it's going to change a little bit going forward because they haven't announced concrete measures for local government debt and the infrastructure push. So we think that's on the horizon. But for the game-changing stimulus, the debate is still on, and there are some uncertainties for sure.